Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be talking about all my dividend income for the month of May. If you do enjoy this type of content, definitely subscribe to the channel if you haven't already. I do post weekly investing content. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. With that being said, let's first take a look at my portfolio. My total amount invested right now is $29,127. So if you guys remember from the last video, this has not changed one bit. My current value is sitting at $38,500, which means that I have an unrealized gain of about $9,400 or a 32% total return. So far, I've earned $950 worth of dividends, and my yearly projected income going forward is $689.64. This is not including any money that I earn from, kind of like money market funds or from high yield savings accounts. My portfolio yield sits at 1.79%, which is where I do prefer to have it. I like it under 2%. I think it's a little bit safer right there. And my yield on cost is 2.37%, and that's because of the price appreciation I've had in my holdings. Now, although it's rather small, this graph right here does a better job of illustrating kind of the yield versus yield on cost of each of my holdings. Right now, most of them have a higher yield on cost than the yield that they're currently going for. One of the outliers to that would be North Ground Corporation, which I have kind of seen a decrease in value since I purchased it over a year ago. I currently have 24 total holdings, and my cash position is about $4,767. So I'm kind of sitting on some cash waiting to see if there's any good opportunities that open up in the market. I think right now a lot of stocks are pretty overvalued, so we'll see where it goes in the next 30 to 60 days. Now, if we take a look at this table right here, we can see how much I've invested, from 2020 all the way to 2024 and how many dividends I've received each year. So in 2020, I only received $12.45 worth of dividends. And fast forward to 2024, we're already at $217.50, which means we've eclipsed 2022's $191.87 worth of dividends. The next milestone, of course, is to beat 2023 at $459. And based on our yearly projected income, we should be able to hit that pretty comfortably this year. Now, if you remember back in January and February, we were barely making any progress on this graph down here, but right now we're actually climbing pretty quickly, about halfway towards our goal for beating 2023, and by the end of this year, it'll be significantly higher, hopefully around $500 to $600. Now, my monthly dividend income is actually not super consistent. That's because I hold a lot of my portfolio weight in two ETFs, SCHD and VOO, as you can see better in this, graph right here. But basically, during those months where they pay dividends, you can see it's a lot higher than the other months. So both April and May are pretty small months compared to March and December. Now, going forward, I believe both June and July should be significantly higher months. That's because both SCHD and VOO will be paying on those months. Looking at this graph, we can see that VOO is my highest payer, followed by SCHD pretty closely, and then Altria Group in third place. After that, we have Texas Instruments, which is a company that actually paid me dividends this month, and then we have United Health Group. One of my goals for this year and the next year is to start consolidating my position. I think 24 positions is actually quite a lot, and I'd rather cut that down to around 15, maybe 12 holdings if I'm able to. I have an idea already of some of the companies I would cut out, but I definitely would have to make some decisions, some tough decisions on the other ones because I do like everything that I hold in my portfolio currently. So hopping into the My Pie sheet of my spreadsheet is actually my favorite sheet in this portfolio. We can take a look at my different distributions. So right now I'm sitting at $38,000 worth of portfolio value and $4,767 worth of cash. Stocks make up about 89% of my investment account, and the rest right now is in cash, sitting at about 11%. And I do break down my different stock allocations into three different sections. We have my key to success at 50%, divine dividends at 40%, and speculative at 10%, which you can see down here. Now, looking at this actual calculation here, we can see that I'm pretty close to my goals. So just a little bit off on both the speculative and the key to success section, but that's quite all right for now. Opening up these pies, we can take a look at the actual distribution of what's going on inside of them. So my key to success section is just my ETFs, VOO, and SCHD. Combined, they make up about 50% of my portfolio, and they're very much the foundation of this portfolio. Now, the main goal of my portfolio is at a minimum to track the market. If I can beat it by a little bit, that'd be awesome. If I lose by a little bit, that'd be fine. But if I'm losing by a lot, I would not be happy, which is why I have such a big holding in both VOO and SCHD. I like the growth offered from VOO, and I like the dividend offered from SCHD, so that's why I hold both in my portfolio, just for a little bit of balance. My current allocation for VOO is about 75%, and that's because of the aggressive growth it's had this year, and SCHD is at 25%, whereas my target allocations are 70 and 30%, but I'm not going to be doing any rebalancing anytime soon. For my divine dividend section, it already cuts off the page because I have a couple more holdings than I did before when I first started this. So Coca-Cola and Union Pacific are on the chopping block, but Texas Instruments is one of my biggest holdings at about 7% of my portfolio. Lowe's and Home Depot are highlighted in yellow because I'm considering maybe tossing out one or the other. I think holding both might not be valuable in this scenario, and I do want to consolidate my holdings. Some of the other positions I really like in here are my Apple and Microsoft holdings, of course Visa and MasterCard, and S&P Global. One of my newer purchases, which has made it to the bottom of this list, is United Health at 6.4% of portfolio, and I've recently allocated a decent amount of money to it. Now, my speculative section is either companies that don't pay dividends or, companies that aren't as safe as my divine dividend section. So we have companies like 3M here, which has seen a big decline over the past couple of years and has not been able to recover for a while now. Also, Target did find its way into this section of my portfolio after it had all those controversies and dipped a good amount in stock price. It has since recovered a little bit, but we'll see where it goes from here. I also have non-dividend pairs like PayPal and Tesla. I think they offer some opportunity for growth, and we'll see how they go in the future. Now, just one thing I do want to note is Google actually did announce recently that it's going to be paying a dividend. So once it starts paying that consistently, I'll probably be moving it into the divine dividend section of my portfolio. But for now, I'll have to wait and see what they decide to do with their dividend. If they're going to pay, they're planning on paying quarterly, but are they going to be increasing it every year, or are they going to keep it stable? All right, and now for the reason everybody's here, let's look at my monthly dividend income. This was not a big month for me. It was $26.57 of total dividend income, but it was from some pretty good companies. On the 8th, we had Lowe's paying out $2.23, and then after that, we had MasterCard paying out 67 cents, General Dynamics paying $2.89, and Apple paying $2.27. To wrap up this month, we had my biggest dividend of the month from Texas Instruments paying out $18.51, and it's a pretty big position of mine as we saw a little bit earlier. And aside from that, I did get paid $14.75, and that's just from the money that's sitting around in my account, kind of the cash that's sitting in money market funds. I don't exactly consider this a dividend, though I know some of you guys do, but I started tracking it just so I could let you guys know what the total amount I've received over time from this is, and the total right now is $449. For all the calculations you see on the spreadsheet, it does not take into account how much I make off my money market funds. I think that would be a little bit misleading, so I just leave it to dividend income only. So hopping into my portfolio holdings section of my spreadsheet, we can see them all ranked here by total return. So right now, General Dynamics is number one. It's been on an absolute rampage this past year, up around 40%, and we'll take a look at that in a little bit. Apple and MasterCard both come close in second, and we have Texas Instruments and Lowe's following them towards the end. The reason Lowe's is highlighted in yellow is because the current price is sitting pretty close to my average price paid. I have some conditional formatting to let me know whether they're, kind of close in case I do want to purchase more of this company. In total, I've only purchased 2 shares of General Dynamics, and I kind of wish I would have purchased more, but that's okay, and I have about 9 shares of Apple. MasterCard is one of the smaller positions in my portfolio, only 1 share, and I only own 2 shares of Lowe's, but I do have a very sizable holding of Texas Instruments. In total, this is how much I've invested in each of these companies, and the current value shows how much it's currently worth after, price appreciation and dividends that have been reinvested. My biggest monetary gain is Texas Instruments at $646, followed by Apple at $554. But if we look at the actual percentage of growth, General Dynamics comes in first at 45.56%, followed very closely by Apple, and then we have MasterCard and Texas Instruments with some sizable gains as well. Lowe's is not bad at 14%. It was sitting higher a little bit ago, but it's certainly come down since, and I think there's a lot of pressure because of the lack of fire in the housing market, basically. People have definitely cooled off their spending at companies like Lowe's and Home Depot, and that's definitely going to affect them negatively for the next couple of quarters and maybe even couple of years. We'll see when they're able to turn it back around. Now, Texas Instruments is sitting pretty nicely with a 30% gain, but I would caution investors. I think this company is getting pretty overvalued, and their pay ratio for their dividend is very high right now. They're definitely seeing a decline in revenue over the last couple of years, and I'm not sure when they'll be able to turn it back around. I do think a lot of this growth is just fueled from the AI craze in general, and probably Texas Instruments being added into certain ETFs that have to do with semiconductors. By buying the ETF, you're also buying a load of Texas Instruments, which is of course pushing the stock price up if there's enough demand for the company. I think in the next couple months, we'll see a sizable decline in Texas Instruments stock price, but for now, I'll be holding on to my position because I am a buy and hold investor. I don't like to sell positions unless I kind of have to, and we'll catch up later, in a couple months and see how this company is doing then. In total, my largest dividend payer here is Texas Instruments at $55.02, and then we have Apple at $13.47 and General Dynamics at $10.86. Going forward, I can't expect Texas Instruments to be paying me $74.54 worth of dividends, but I'm not sure how safe their dividend is at the moment because of their very high payout ratio, and we'll definitely see a decline in that dividend growth rate over the next couple of years probably. Since I have seen a pretty sizable gain on all of these companies, the yield on cost is much higher than the actual yield they're going for right now, and this is my portfolio allocation by stock. So I'm not going to go through every company that paid me a dividend this month, but for General Dynamics, I do want to take a quick look at them because in the past year, they're up almost 40%, which is very high. Defense companies are definitely known to perform very well in the stock market, but they're not known for crazy fast growth rates like we are seeing right now. Year to date, the company is up over 15%, and in the past 5 years, we can see that they're actually up 72%, which is pretty strong. Now, it seems that this company is a little bit more cyclical if we take a look at their 10-year growth rate, where they have, periods of increasing stock price and then periods of decreasing stock price, followed again by, ups and downs once again. I'm definitely a little worried about their valuation. If we take a look at their valuation metrics on Seeking Alpha, we can see that their current price to earnings ratio is at 24, which is a little bit on the higher side, but their forward-looking price to earnings ratio is not as bad at 20.5. Comparing it to their 5-year average, it's definitely trading at a premium right now, which is not the greatest thing to see, and there definitely might be a correction in the stock price. Now, I'm not exactly sure what catalyst is pushing this growth for this company. It could just be the conflicts, across the world that we're having right now. And they do get constant new bids and constant new contracts with the government, but that is still pretty crazy growth for a slow-growing defense company like this. The revenue growth is still solid, with the year-over-year growth being 8% and their forward-looking growth at 7.41%, which is higher than their 5-year average for both, but we'll see how they perform going forward. A lot of the work that this company does is very capital intensive, and although the government contracts are lucrative, it's still hard to get good profit margins on their work. If we hop into profitability, we can see their gross profit margin is only 16%, and the government does try to usually cap the types of profit that these companies can make so that they're not making too much money off of, taxpayer money. But anyways, besides that, we can look at their dividend stats. Their dividend growth history is 29 years, making them a dividend aristocrat, and their 5-year growth rate is 7.14%, and they had a pretty nice growth bump this year at over 7%. Their pay ratio is under 50%, which is not bad at all, and their yield is 1.9%, which is pretty strong. Taking a look at Apple, it is sitting near its 52-week high at $196.89, and it had a pretty strong year, though it has had a good amount of ups and downs, kind of different controversies coming up, and mixed earnings reports really is what's been pushing the stock price. Right now, it's up 10% this year, and year to date, it's only up 2.26%. Now, as you guys know with Apple, if we look at the 5 and 10-year performance, they're both pretty absurd, up over 750% in the past 10 years. Their price to earnings ratio is getting a little high for what this company is known for historically at almost 30, but we'll see how they perform going forward. One thing that I do want to know with Apple right now is that their growth is pretty limited. Their year-over-year growth is actually in the negatives, and their forward-looking growth is expected to be very low single digits. So we'll see if they're able to come maybe with some new product or some increased sales for their company. Taking a look at their dividend scorecard, they do have 10 years of consecutive dividend growth, which is pretty solid. Their 5-year growth rate is 5.56%, which is lower than what I would like, but they do put most of the money into stock repurchases, so that's not too bad at all. And their pay ratio is under 15%, which is very, very healthy. Their dividend yield is 0.51%, so if you're buying this stock looking for dividend income, this is definitely not the choice for you, but if you're looking for, stock price appreciation, dividend growth, it might still be a good option. And real quick, looking at MasterCard, they're up 21% this year, they're up 5% year to date, their 5-year performance is up 69%, and their 10-year performance is up 490%, which is very, very solid. Their price to earnings ratio is trading at a premium compared to companies like Visa, but it's still pretty healthy, I'd say, for the amount of growth they've been experiencing. And compared to their 52-week range, they're about 3/4 of the way towards their 52-week high. So maybe potentially it's a buying opportunity if you don't hold the stock at all. For me, for now, I'm going to be sitting on the sidelines since I already have a position in both MasterCard and Visa. Now, I do like this company a lot, and if there are any big dips in stock price, I'll definitely be purchasing some more. But for now, for the past year or two, I haven't really purchased any since my initial investment. Taking a look at their dividend scorecard, this company is a dividend growth machine. Their 5-year growth rate is over 16%, with even the recent growth being very strong, and their dividend growth history is at 12 years of consecutive dividend growth. Their pay ratio is under 20%, which is very healthy, and their yield is very small at 0.59%, but the yield on cost for people who bought this company a long time ago is very high compared to this. Now, taking a look here, we can see what I mean by that. If you bought this company 10 years ago at a yield of 0.58% at the time, your yield on cost would now be sitting at 3.6%, which is very good. Next, we have Texas Instruments. They haven't been having the best time, very cyclical growth in the past, year, the past 5 years. We can see that they kind of increased very quickly back in 2020 to 2021, and they plateaued for a long time actually with declining growth rates, which was not good for the company's stock price at all. Zooming into the 1-year time frame, you can see in October how drastically this company's stock price dipped, and during this downfall right here is when I was purchasing all my shares, so I ended up picking up a total of 14 shares as it declined all the way down to $140 per share. Since then, the company has recovered pretty aggressively actually and is now sitting at almost $200 per share, very close to its 52-week high with a pretty elevated price to earnings ratio at 37. Now, I would not go and say this company is a steal right now. I think it has a lot of risks associated with it. I think a lot of the reason that we've seen this recent growth rate is because of the other big pushes in AI and the other semiconductor companies experiencing high growth, but I think that this growth is not quite justified for Texas Instruments. Like I said earlier, I will be holding my position for the time being, but I do think there will be a pretty aggressive correction to the stock price in the coming quarters. If we take a look at their dividend scorecard, we can see that they have a good history of consecutive dividend growth of 18 years. Their growth rate is very high at about 12%, but their most recent dividend growth hike has been pretty low, and I think the next one will also be pretty low as well. Their pay ratio is set to be sitting around 80% right now, but I do think it's actually over 100% based on future looking earnings. So we'll have to see where that goes in the next quarter or two. And their dividend yield sits at 2.66%, which is pretty sizable. And the last company that I received a dividend from that I want to take a look at real quick is Lowe's. They are up 124% in the past 5 years, which is incredible. But if we look at their more recent performance, we can see that it's been very cyclical. In July of 2023, the company was sitting at $234 a share, only to decline in October all the way down to $187 a share, which is when I bought one more share of this company. And then since then, it's rebounded pretty nicely, only to start declining once again. Earnings on this company have been mixed in the past couple quarters, and their forward-looking growth is not that high. So right now they're trading at a price-to-earnings ratio of about 17, which is not too bad, but I do think their growth in the next couple of quarters is pretty limited. In terms of their 52-week range, they're sitting at right about the middle, a little under that. So if you are looking to start a position, this might be a decent price. I feel like it's been hovering around $200 to $220 per share for a while now. And lastly, taking a look at their dividend history, they are a dividend king with 60 years of consecutive dividend growth history, and their 5-year growth rate is fantastic at 18%, though their last increase was a little bit over 4%, which is not as strong. Going forward, I think we'll have to expect some lower single-digit increases like the one we saw this year, and also the one we saw last year was not that impressive as well. Their pay ratio is under 40% at 35%, which I think is very healthy, and their dividend yield is 2.12%, which is also pretty good. Alright, so before I end this video, let's take a look at my future value calculator, and if you guys do want to see how to make your own future value calculator, I'll leave a link to the tutorial right here. My starting principal is how much my portfolio value is currently sitting at, which is $38,517, and my annual contribution is how much I'm expecting to contribute each year going forward, which right now is $12,000 or $1,000 per month. My annual dividend yield is my portfolio's dividend yield, which we saw earlier, which was 1.79%, and then for expected dividend increase and price appreciation, I can kind of change it based on however I expect to be. For now, let's leave the expected dividend increase at 7%, and let's also leave the expected price appreciation at 9% going forward. Now, after 10 years, my portfolio value should be at about $263,000, and my dividend income will be $3,800 per year. Now, of course, what's more interesting than that is looking at the 30-year return. So my portfolio value after 30 years will be $2.5 million if I continue investing and getting this price appreciation that I've listed right here. And my dividend income per year will be $21,000 with a total return of 548%. Now, some of you might think this dividend income is pretty low, which of course it technically is, but you can always rebalance your portfolio to have higher paying dividend stocks later on in your time horizon. After 40 years, you can really see where that snowball starts taking effect. $6.5 million of portfolio value, and dividend income will be $43,000 per year, or a total of $566,000 worth of dividends reinvested over that time period. You can really see how steep the graph starts becoming towards the 40-year mark as it increases much faster than before, and the same can be seen for the dividend income. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at my dividend income for the month of May, and I promise you June will be a higher month of dividend income. Comment down below which dividends you received this month and which companies you purchased. If you did enjoy this video, I'd appreciate if you were able to leave a like on it and subscribe to the channel if you haven't already. Like I said before, I do post weekly investing content. If you have any recommendations for the channel or any videos you do want to see in the future, also leave those down below. If you haven't seen my video from last week yet where I go over Johnson & Johnson, which is a dividend king at its 52-week low, check it out right here. And if you do want to check out my video where I go over Intel Corporation, which has also been crashing recently, check it out right here. Other than that, thank you guys for watching, and I will see you next week.